So welcome everyone, I'm Alexander Mihalcea and today we have one of the industry leaders, Ryan Baird, CEO of Baird Augustine. Welcome Ryan, how are you doing today?
I'm doing great. Thanks for having me.
Awesome, and I'm very excited to have you on the podcast today and I'm sure you're going to be of great value for the audience. Now, before we dive in, could you give us a quick overview of what Baird Augustine does?
Sure. So Baird Augustine is our investment bank, and we work with 33 family offices that are deploying $20 billion annually. A lot of that is going into private credit. We have a lot going into crypto lending, and the rest is specifically earmarked for GP investments across the alternative asset classes. And then the rest is direct investments, stock investments, bonds, etc. We typically work with founders that have had $100 million plus exit. We find that it's much easier to raise for these individuals, and the family offices that we work with are most interested in successful founders. So we really just cherry pick who we work with and help them raise hundreds of millions of dollars, if not billions of dollars.
Okay, that's really fascinating. And basically, what inspired you to create Baird Augustine? And when you saw that opportunity, what gap in the system did you realize no one else was solving?
That's a great question. So I'm actually third generation Silicon Valley. Both my parents worked for Hewlett Packard their entire careers, and I have the HP way ingrained in me, which is a focus on relationship based businesses, not transactional businesses. So when I was doing global venture, I met a number of multi-generational family offices and introduced them to some of the biggest investment banks in the world. And I was shocked at how transactionally they were treated. So we came up with the idea to bring relationship-based investment banking back. And that's really our main focus. If you notice, Silicon Valley was founded on relationship based businesses. Again, Hewlett
Yeah.
Packard, very focused on relationships. Wozniak had an internship, excuse me, Jobs had an internship at Hewlett Packard. Wozniak worked for Hewlett Packard. Apple was very much a relationship based business when it first started. Google, Meta, they all copied HP and Apple. And when they were young companies, they've had a very strong relationship based culture. However, over time, as these companies have gotten bigger and bigger, and they've reached 30,000 employees, 40,000 employees, 50,000 employees, the CEO can no longer remember everyone's name. The CEO can't remember if the individual is married or if they practice a specific religion or really any details about their employees. And we've noticed the average tenure or the length of time that people stay at a company has dramatically dropped. It used to be over 10 years people would build a career at a company. But as these large corporations have become more transactional, we've seen the average tenure plummet to around 2 years. In fact, of the Mag 7, only Tesla and Nvidia have a longer tenure than 2 years. So Silicon Valley has become a lot more transactional. And I just believe that we need to help Silicon Valley get back to its roots so that we can continue to accomplish big things. And the only way you're going to do that is with a relationship based culture.
Interesting thing here. But for example, what was your background like before starting this venture?
So I started my career right here on Sand Hill Road, working with Morgan Stanley, dealing with their top clients with $50 million of investable assets or greater. And I was the equity and derivatives guy. So after I left Morgan Stanley, I went to Maverick, which was a hedge fund that was just focused on option arbitrage, and worked my way up, became the number one trader there, started my own hedge fund, Flotilla Partners, ran that from 2010 to 2014. I spent some time in technology doing corporate development, helping companies or we were looking for companies that we can merge with or acquire. We were also doing a lot of buy versus build analyses. And then after that, I did global venture for a number of years. And that's where I got to meet even more family offices. And that eventually led us to start Baird Augustine. After I did global venture, I ran my own startup, Leica. We raised over $35 million for it. We had 11 million monthly active users in the Philippines and had a really unique experience running that startup. But once I realized the startup was winding down, I had a number of people that wanted me to either be the CEO of the company to help them raise 100 million plus, or they wanted me to be the head of corp dev, again, having me raise $50 million and then again over 100 million plus. And it struck me that instead of putting all of my eggs in one basket, I could partner with my friend Henry Augustine, who had already gotten his investment banking license, and take on these clients, which were larger clients than what he was dealing with at the time. So us coming together and forming Baird Augustine really just made an unbeatable team, and we continue to execute.
Amazing, amazing, and a significant growth, honestly, from early beginnings to now. But for example, like if we're looking back at those early days, what do you wish you've done differently?
Well, I got really into options and derivatives, and that's mostly because I went to a hedge fund where we were arbitraging volatility. And I started my first fund, Flotilla Partners, to arbitrage volatility for decades. I really believed that I was going to be able to do that. However, arbitrage, it's great when it's there, but it eventually goes away. And by the time it went away, we really couldn't adapt. And I had to shut that fund down. And really, ever since then, I've been looking at a number of different strategies to actually find a strategy that we could execute on and run a fund for multiple decades. And that's what we've done with Asymmetrical Alpha. We were the number one performing hedge fund of 2024. Really excited about where we're going to close this year. And we're just looking to continue to invest in early market leaders. And then we really just want to hold them for decades and let them compound.
Okay, okay, amazing. And basically, with all your background in trading, venture, and investment banking, you emphasize the risk as the single most important topic right now. So, my question is, why is risk management the critical factor for success in today's market?
That's a great question. So, a little bit of a frustration that I had when I would meet founders is that they would talk about what Lamborghini they were going to buy or what color Ferrari they were going to be driving when their business became a unicorn. And it just felt like unnecessary effort into thinking about these things that could potentially never happen. And what I've noticed in investment banking, in hedge funds, in trading, anything that has to do with money is that people like to focus on the profit. They always want to know how much money they're going to make. They always
Yeah.
want to know, what they can buy once they've had this success. And that's really the wrong focus. You really want to focus on your risk, and you want to focus on the onion layers of risk, and you want to keep peeling the layers of risk away from your business and removing the things that could end your business so that you can be successful later on. And I think if people could change their focus from how much money they're going to make to how can I survive another day, another week, another month, another year, another decade, what's my biggest risk from losing that? And I think they're going to have much better outcomes if they have that framework.
And this also like keeps your internal hunger, right, from inside. And basically, you want to gain more. Basically, this is like a mindset shift, like you mentioned before.
Yeah, absolutely. Amateurs focus on profit, and you can't control your profit.
100%, yeah.
But
And
professionals focus on risk because you can control your risk, right? If we can control our profit, we would all be on an island somewhere with trillions of dollars or infinite dollars. But you can't control your profit. So it makes a lot more sense to focus on risk.
100%. And as a risk manager, like during the great financial crisis, what is the biggest lesson you learn about the market volatility that you apply to venture investing today?
That's a great question. I'm not sure there's a lot of lessons for hedge fund managers to learn from venture. I think there's a lot of lessons that venture can learn from hedge fund managers. And part of it is hedge fund managers are not speculating on, I mean, some of them do, but the vast majority of them are
Yeah.
not speculating on a new business model. They're not speculating on, will this company make money, right? They're actually investing in a lot stronger balance sheet, and they're investing in a lot stronger type of company. Where venture capitalists, especially on the early stage, I mean, it's almost like they're buying penny stocks. They just don't realize it. And yeah, lots of penny stocks could have this huge potential, but we know that the vast majority of them can't execute. And the same thing's true with startups. I think another thing that's really interesting to me about venture is I hear a lot of VCs telling LPs that the reason why they should invest in them is because they give entrepreneurs really good advice.
Yeah. Right.
I don't want to invest in an entrepreneur that needs my advice. I want to invest in winners that are going to take this company from a couple billion to hundreds of billions, if not trillions of dollars. And I think if more VCs recognized that they actually don't want to be investing in founders that need their advice. They want to be investing in the most elite founders that can just execute with or without them.
Yeah, makes sense. But for example, like on the flip side, what are the key for non-financial risk that founders often overlook when they focus purely on scaling and raising capital?
Well, there's a lot. I think one of them is that most founders at the early stage don't work on their pitch enough. They don't work on how they speak enough. They don't work on articulating their ideas in the most simplest form possible. And I've seen this really hurt a lot of founders because when you're pitching an investor, many founders think they're just pitching that one investor and they're trying to get this investor to give them money. And while that's part of it, another part is investors are looking at the founder and asking themselves, can this founder raise the next round? And can they raise the next round after that? And can they raise the next round after that? So even if you have a great product, great traction, great company, but investors don't feel comfortable that you're going to be able to raise capital from the next set of investors, it's an easy no. And a lot of
Yeah.
founders don't understand this. Another reason why the pitch is super important is that investors want to understand, are you going to be a founder that's going to have to pay for a lot of services and be at a disadvantage? Or are you the type of founder who can articulate your ideas clearly so that you do not need to hire all these extra services? For example, can you recruit? Can you speak clearly enough? Are you likable enough to recruit people to your team? Maybe they're taking a pay cut. Maybe they're leaving a more prestigious company. But do you have the ability to, or are you going to be stuck hiring recruiters? Can you pitch your business not only to investors, but can you pitch your business to media? Can you get earned media? Can you get free media? Or are you going to be the average founder that has to pay for a PR firm? So there's lots of examples like this, and a lot of times founders just don't have the experience to actually be a founder, and that causes a lot of problems for a lot of people. You know, starting a startup is one of the most difficult endeavors you could ever do. And yet some people start a startup because they lost their job and they can't get another job. That's not a reason to start a startup. Typically, the founders that are extremely successful already have a great job. They've already worked at a publicly traded company. They've already worked at one of the top and on their nights and weekends, they keep working on this other idea that they're extremely passionate about. They get an MVP out there, they get some early traction, and then they're able to raise capital.
Right, right. I like that you are speaking exactly the truth, even though some of our like listeners will be like a little bit harsh for them.
Look, I call our group Focus on Risk to let people know exactly what I'm going to be talking about. If the truth is seen at harsh, you don't have what it takes to be an entrepreneur,
Yeah.
because me helping you shouldn't be seen as a harsh way of communicating. This is something that I think other entrepreneurs can recognize, maybe spend a weekend really perfecting your pitch and help them get to the next level.
Yeah, right. Makes sense. And for example, now let's talk a little bit about the current market, current nowadays, and how does this modern structure help companies navigate the unique risk of raising capital across different international markets with the cross-border new investment bank that I'm talking about?
Well, this is the greatest time to ever start a startup. If you're a tenacious founder who will not give up, it's never been cheaper to start a startup. You've never needed less people in order to get to the Series A. And because it's so much easier to start a business and get traction, we're seeing an explosion in the startup space. And there is some confusion around who should be getting capital and who shouldn't be getting capital, but I believe the ones that are executing are getting all of the capital that's out there right now. I think the days of people being pre-revenue and raising capital, I think, is extremely difficult. When we see AI companies, they tend to already have $1 million in annual recurring revenue, and they're raising a seed round. So I think I remember reading an article where a Series a few years back would typically have 30-ish people on the team, and now we're seeing Series A's with 20 people on the team, sometimes even a little bit less, and I expect this trend to continue. Now, some people might be thinking that, oh, I'm suggesting that there's going to be less jobs. I actually think we're going to see a huge influx of new jobs that haven't even existed before. And I think we're going to see the sales role really expand. Now that you can automate all of the boring stuff that people would have to do in the past, now you can have people spend more time building relationships with people, spending more time understanding what their business objectives are. And I think there's going to be a deeper understanding of business development guys and sales guys of understanding their customer. And because they're going to be more ROI positive, companies are going to be able to hire more sales and business development individuals.
100%. And this comes like to your idea, like adapt your pitch, adapt your words, your speaking, and this is basically all improvement that you have to do.
Yeah, absolutely.
Yeah.
I tell
And
people all the time, you got to get rid of the California accent. You know, Hollywood is in California. So when you watch media, you hear the California accent, but you really got to remove the California accent. No likes, no ums, no us, no slang, no acronyms, no hella, no rights. If you can speak clearly and articulate yourself, you will be in a position to work on $1 billion deals where
yeah.
everyone else can speak clearly. If you can't speak clearly, you're going to end up working on smaller deals than if you could articulate yourself better.
Right, right, makes sense. And now I have a curiosity about this. So, how does a disciplined focus on risk management directly help founders build trust and secure capital from institutional investor and family offices?
Well, building relationships is an art form all to itself. And it's important that founders are strong communicators, not only with their current investors, advisors, and board members, but also with prospects that could be investors next year, next month, next decade. So I really recommend that people write a monthly newsletter. So all of their team members understand exactly the vision, where the company's going, what has been accomplished, what they need from their advisors or board members. And in this letter, it's extremely important to practice UPOD, UPOD, which stands for under promise, over deliver. If you're writing a newsletter and you tell your prospective investors that you're going to have 100 clients by next month, you have a really big opportunity to beat that 100 number. Tell them that you have 120 customers and that the business is booming and it's doing even better than you thought. And Steve Jobs popularized this back in the day with Apple. And I've seen great success from entrepreneurs that also do this. If you tell investors that you're going to have 100 clients by next month and then you have 80 clients, it's an easy pass. The business isn't doing as well as the founders thought, and I can go invest in a company where the business is doing better than the founders thought.
Yeah.
It's really amazingly simple and amazingly complex at the same time, but under promising and over delivering is the classic Silicon Valley saying. And you see entrepreneurs all the time that exaggerate their business, exaggerate what they're going to do, and people sniff it out and it's an easy pass. And these are the founders that are in Silicon Valley that end up having to go to Austin, or they end up going to Dubai because they can't raise money in Silicon Valley. So they need to go and speak to tier 2 investors. And San Mateo is a small town in Silicon Valley. It has a higher GDP than Dubai. So founders that are leaving the mecca of venture capital to go raise money from unsophisticated investors is another signal that you really want to avoid that company like the plague.
Right, right. Makes sense totally. And also, you launch like your own fund flotilla and arbitrate volatility. So, what is one core strategy from the hedge fund world that any founder can apply onto their business strategy?
I think the only way to connect entrepreneurship to arbitraging volatility is to focus on risk. That's the only two similarities. When we were arbitraging volatility, we were basically always in the market willing to buy cheap volatility or sell expensive volatility. And then we would just close the position at fair price. So arbitrage is a very interesting art and science. And I think the biggest lesson people could take from my arbitrage days is to really just focus on risk. What is the biggest risk to your business? What's the one thing that you can do to remove these layers of risk and increase your chances of success? To me, it's all about risk. And people can talk about other things here and there, but you're really just talking about another form of risk. You have go-to-market risk, you have PR risk, you have recruiting risk, you have capital funding risk. So if you can just consistently focus on what your biggest risks are and go after those and remove those layers of risk, I think you're going to increase your chances of success. A lot of times the mistake that entrepreneurs make is that they have a list of problems and they go do the easiest thing on their list
Yeah.
that maybe doesn't have as big of an impact, right? If what's more important, closing a customer or taking another meeting with an investor,
Right, right.
right? If you start closing clients and you start making a name for yourself, investors will come banging on your door. They have a fiduciary responsibility, LPs, to go and find companies that are breaking out. So Oftentimes when founders are reaching out to investors, they're reaching out way too early. They don't understand the investment thesis, and it causes a lot of confusion in the venture space.
Right, right. And it's better that you said this because I like always tell to people this exactly proposition, and they okay maybe, but because you tell and you have like a lot of experience in this field, it's better to understand like for most of them, right? And for example, like in your opinion, what is the one actionable step our listeners, founders, and investors should take this week or the next one to improve their focus on risk?
To improve their focus on risk, well, what I would do is call a team meeting, get everyone's ideas. What are the biggest risks to our business right now? Maybe your team understands a risk that you haven't thought of. Maybe your team believes there's a big risk in the business that actually doesn't exist. So it's our group is called Focus on Risk. To take that literally, you got to focus on it. You got to spend time to discuss it. Sometimes one founder will think that the biggest risk is not getting enough revenue, and the other founder will think that the product's not ready. So coming together and really trying to be smart about what they need to go after is extremely important. So talking about it with your founders and your coworkers is extremely important. Talking about it with your investors and board members and advisors also extremely important. And by focusing on risk, all of your teammates are going to appreciate you because they would much rather have a productive conversation about how to make sure that this company doesn't fail versus having a conversation about what color Ferrari you're going to buy if and when a bunch of other things happen. So I think as long as people start thinking about it, it will dramatically help them. And some founders, they get it. They're already focused on their biggest risk and they're hyper focused on it. And those are typically the ones that attract investment.
And yeah, and like Ferrari is good, but not now, a little bit later in the process, right?
Yeah.
Yeah. And you also like organize prestigious events like G Startup Worldwide. So could you tell us more about the upcoming Silicon Valley Economic Forum and who needs to be there?
Sure. So I started the Focus on Risk community back in 2000. And what happened was we went to a number of events and we realized that these events are primarily for founders. And that's super important, needs to exist, critical part of the ecosystem. But as a family office, I don't want to go to an event and meet 100 unfundable founders. And that's what happens in Silicon Valley and all major metropolitan areas all of the time. Because typically what happens is founders end up hosting these events. So they want to invite investors and other founders.
Yeah.
But I really do think that's a mistake because billionaires and centimillionaires and high level investors, they don't want to go to an event to meet 100 unfundable founders. They want to go to an event and meet maybe 5 extraordinarily high quality founders, and maybe one of them might be of interest to invest in. It's far more productive than the alternative. So we started hosting events, and we would have angels and VCs there, but much more importantly, we would have hedge fund managers, private equity managers, really GPs across the alternative asset classes. We would get the head of M&A or the head of corp dev from a publicly traded company. And by bringing together all of these networks, we were able to help a lot of people reach their business objectives. So we started doing these events across the country, and then we did them around the world. And the big lesson from doing them all around the world is that when we do an event in Silicon Valley, it's much higher quality than anywhere else. And that's just because we're in the Mecca. This is where
Yeah.
the venture capital is at its strongest. This is where institutional investing and institutional family offices are at their strongest. So we go and talk to the investors that are going to be attending one of our events, and we ask them for the breakout portfolio company. Another big problem with a lot of these events in Silicon Valley and all over the world is when you see a VC share one of their portfolio companies, it's typically the one that needs help. It's the one that needs to raise capital before it goes to zero. And we don't want to show our family offices companies that may go to zero soon. We really want to show them the breakout portfolio companies. So we allow the investors to highlight one of their breakout portfolio companies. We get to hear the opportunity from the founder, but more importantly, we get to hear from the investor. Why now? Why this team? Why out of the millions of opportunities that are out there, why are you spending your time and money here? And by calling the group focus on risk, by asking tough questions, by having high level people in the room, and by removing all of these founders that will never ever raise capital ever, it makes our event a lot higher quality. And we are very fortunate to do these events and remixes of these events all around the world. We've done them in 19 different countries. And after realizing how much stronger our Silicon Valley events are than our global events, we're just 100% focused on Silicon Valley now. So every month we host a handful of events. We do a regular poker game in Atherton. We do an early morning hike around Lake Fasona here in Los Gatos. We do private sailing trips around the bay. We do private dinners, all to keep our community engaged and so that we can meet more high-level people. And this is all for our main event, which is called the Silicon Valley Economic Forum. We've partnered with the city of San Jose to do this event for the next few decades, and we're going to follow the exact same formula that we've used in Silicon Valley and all around the world. And that formula is we're going to get institutional investors with 100 billion plus in AUM or greater. We're going to get CEOs who've taken a company public. We're going to get a number of elected officials. We're going to have our family offices fly in from all over the world to see this. And then, of course, we're going to feature top tier GPs across the alternative asset classes. And we're going to feature our clients. Again, many of them have already sold their company for 100 million plus. And by doing that, we have a really high level event and help investors and entrepreneurs reach their business objectives.
Interesting things. And now looking ahead, like what is the single biggest risk or opportunity you see defining the cross-border institutional investing landscape in the next, let's say, 12 months?
The best opportunity for cross-border investing, I think there's a couple things. I think one of the more interesting opportunities in cross-border investing is just going to different geos and investing in the absolute best company. I think going to other geos and investing in early stage startups is way too high risk. If you don't live there, you're not going to meet the right founder in one weekend or 1 week that you're there. And then I think the other biggest opportunity right now for cross-border is debt. We've been seeing a lot of founders that have recurring revenue opt to not go the VC route. Instead of pitching VCs, they're just getting debt so that they can expand their team and grow into their valuation. And they might not ever have to raise capital after that, or they can raise at a much higher valuation and give up less of the company. We're seeing this with AI companies, and we're also seeing this with crypto companies. Now that crypto is becoming more mainstream, there's a lot of people that will let you use your tokens as collateral. In fact, one of our family offices that's deploying $6.5 billion per year into crypto lending, they can give 85% LTV on Bitcoin, 75% LTV on Ethereum, 70% LTV on alt tokens that have $100 million market cap or greater, which is pretty extraordinary. That did not exist a few years back. And we're seeing a lot of founders who have had a successful launch just use their token as collateral. They raise 10, 30 million bucks as debt, instead of going to a VC and giving up tokens and equity, and they're just building their business. So the cost of capital for crypto has dramatically shifted over the last 12 months, and we're seeing a lot of entrepreneurs take advantage of it.
Okay, interesting things. And then before we wrap up, I'm curious about what's on the horizon. So when you look at Baird Augustine's journey over the next few years, what possibilities excite you the most?
I would have to say AI. We really believe that investment banking needs to be relationship first, and we're leveraging AI to automate absolutely everything we can so that we can spend more time with our clients. So the first tool that we created is our proprietary AI email system. Works incredibly well. Basically, every 70 emails that we send out will get one interested investor. And then of about 30 interested investors, we'll be able to close one of them. This is a lot better than traditional email that we were using when we first started. So we're really excited about being able to help our clients even more now that we have this tool. The second tool we're building is AI agents for debt. We work with some incredible family offices on debt deals that are $50 million and above. And I still believe that those types of deals are going to be largely relationship focused and more in person. But for loans that are $25 million and below, I think we can automate a lot of it. There might still be a couple spots in the process where a human just needs to double check the system and ensure everything is working. But the vast majority of the rest of debt automated. And I think this is just going to give better prices to consumers. It's going to really expand the size of the market that we can service. And we're going to be able to help a lot of entrepreneurs that we wouldn't have been able to help, just a few months ago, which is really exciting. And I think as more and more investment banks become more technology first, we're going to see this whole industry become a lot more efficient and people becoming a lot more successful because of these tools that are being built right now.
Yeah, exactly. And it seems like it's a lot to do on the horizon, honestly.
There's a
And
lot to do, but that's what keeps it
yeah,
exciting.
exactly, exactly. And for listeners who want to learn more or potentially work with Baird Augustine, what's the best way to get in touch?
You can go to our website, bairdaugustine.com. You can also just search us. We're pretty active on social media since we record our events. Um, if you just search Focus on Risk Ryan Baird, you'll find our Facebook group. You'll find our YouTube channel. We're pretty easy to get a hold of after that.
Perfect, perfect. So thanks for joining me today, Ryan, and for this amazing podcast session. And for anyone listening, make sure to check out Baird Augustine with socials below in the description because this episode was packed with value and I can wait to see what you build next.
Thank you so much, Alexander. I appreciate it.
Great. See you in the next episode then.
All right. Take care.